All right. Hey, everybody. Welcome to Ask Me Anything. We'll go ahead and get rolling here just a moment. Go ahead and use that comment box. Go ahead and put in any questions you guys have, and we'll go ahead and get rolling in just a moment. I don't think I can play the actual video, though, so only Steven can do that.
That's okay. When you go back and watch the replay,
Yeah.
It'll be edited in. You'll see the video. It'll be on YouTube in a little while. But we're happy to be here to serve your questions for another. It's called Ask Me Anything, right? Patty was telling me earlier is WTF. She's like, you're always on the WTF. I'm like, I've never been on the WTF. Sometimes it says that in our background, though. So, Fouts, you said it snowed where you're at today. Let's start there. There's only 3 of us, so we can,
we'll go around the room here.
Yeah.
And then if Steven wants to hop in, he can hop in as well. But yeah, Brian Fouts here. I'm actually in North Idaho now. Moved from Washington State recently. And there's Mr. Steven. We'll get him in the room too here in a second. But yeah, it just snowed. I'm actually happy that I have power and have internet because that might change here soon. Supposed to snow another 6 inches tomorrow too. So it's a new experience for my family. But yeah, so up in the great North Idaho. So there's Mr. Steven. So Mr. Steven and Mr. Joe Helock there. But I'll pass it over to what is Carson doing? Or Steven? Gabe, go over to you.
Hey guys, Gabe in Newmarket, Maryland.
We can't hear you. There we go.
Gabe in Newmarket, Maryland. Exciting. My son's policy just got approved. So nice. my dad's buying a policy for my son. It just got approved today. So we're excited to have that one going for us. And I'm also in a position to transition now. We're looking to buy a little house, a little farmhouse. So we have it under contract today. We had one of the inspections. So I just came back from that not too long ago. But it's been busy over here. And then worked on my slides for tomorrow, Jason. And pass it to you.
Well done for our week 3 of IBC boot camp. Gabe and I going through teaching the fundamentals of stepping on the mat, because we all know that the hardest belt is a white belt, because what do? They got on the mat. They decided they were going to go on the journey to mastership. So down here in Orlando, Florida, super excited, like I said, to be here with everybody today to get the questions. Feels like the first time I talked today. I had a few calls today. I was very quiet in our team meeting earlier, and I was thinking, man, I must be saving it for AMA. So over to my buddy Carson right here.
Yeah, what's up, everybody? Carson Herleen coming from Southern California. Not a ton going on this week, just kind of prepping for end of the year, going through different taxes and rentals I need to purchase to offset my taxes and going through all that stuff, which has been fun and busy. But I'm excited to talk today about IBC, how we can teach you guys banking, how we can show you guys the other side of what money really is. So we'd love for you guys to throw your questions in the chat. We'll get cracking at them, talk about whatever you guys want, real estate, IBC, banking, anything. Let us know where you're coming in from, your questions, guys.
Yep. Go ahead, and anybody got any questions, go ahead and post them in the comment box or chat box right now. I don't think we have any just coming in yet. But anybody else on the call have any unique cases or questions that have come in this week?
Unique. I knew you were going there, and I was thinking, I don't think I've had anything unique. I think I've had more awareness, and I don't know if it's my awareness, but I think more people, maybe because of the amount of knowledge that's available, are starting to see the game that we're actually playing. And that's not just with money, right? That's with our health. That's with school. That's just with other things where people are really seeing, like, wait a minute, I don't think people were telling us the truth about this. And now they're starting to step in and say, oh, well, if they're not telling us the truth, so what is the truth? And then how do I teach that to my family? Like, that was one of my conversations earlier this week with a pretty unique woman who's focused on she wrote a book about kids' nutrition and what's in our food. And she got her whole family off of any medications that are over the counter. So I think that I'm sharing that because I think it's directly in line with what we teach people about going back to the basics and the fundamentals of money and really understanding what the game is, and as simple as changing that one thing that we talk about all the time.
Absolutely. Finally, Suyin said, hey, I just got off the phone with Brian. Oh, yeah. There you go. Yeah, just got off the phone with her. Actually, we're going to be talking here in a little bit as well again.
Idaho. All right.
Yeah, Nampa, Idaho. There you go. So here's some questions got coming in, rolling in. Awesome. So we'll go ahead and get these things addressed. So actually, before we get into these ones, so I did the Wealth Wednesday webinar today, and one of the things that we went over on that presentation was how to pass on wealth, how to pass on generational wealth. And one of the things that came up a lot is that if you don't teach the next generation about money and how it works, and they have the right knowledge, then it's very hard to pass on wealth, because if they don't have the knowledge to receive it, it'll get destroyed, it'll get lost, it'll get dispersed. Essentially, you got to really make sure that you pass the knowledge on, not just money. So when it comes to generational wealth, infinite banking is amazing, but if you don't teach other people how to use it, what are you passing on? Is it just money? Because once again, money is just that tool, but you got to pass on the knowledge as well. So, yeah.
And at what point do you start teaching, right? Because here, my jiu-jitsu school, I teach the same thing to 6-year-olds that I teach to 60-year-olds. And the younger ones are just very open. They don't really question. And they're like, okay. They just trust the goodwill of the instructor, which is great. But a lot of the adults who've had actually previous training, they just have so many bad habits built in. And it's almost like they don't trust. And now you have to almost reprogram completely just because they've been kind of taught the wrong things.
Yeah, 100%. 100%. All right. So here's some questions. So Curtis from Nampa, Idaho says, please explain how to create a whole life policy using the Rockefeller structure.
Curtis came to the right place.
That's a fantastic question.
So who wants to answer that one?
I'm probably sure we can get everybody's perspective on this one. There's a lot of ways we could talk about this. So how to create a whole life policy using the Rockefeller structure. Okay, so essentially when you're building a life insurance policy this way, you are looking to treat this policy as a place or a warehouse of your money, a place your funds can be stored where you gain growth that's tax-free and guaranteed, a place you have protection from creditors, lawsuits, judgments, liens, a place where you have a death benefit for your family, and a place where you still have liquidity. These attributes of what whole life insurance has is why we store money here. If it didn't have these attributes, we wouldn't keep money here. We don't look at the whole life policy as an investment. We look at it as a more efficient environment to store money than most other places, and it's because of those attributes I just mentioned. And so the only thing that's missing from all those attributes, well, the only thing of those things that you don't get in normal life insurance is liquidity. If you went down to your local insurance agent and asked for a whole life policy, you would have no cash value for 5 years, no real cash value to use for 10 years. You wouldn't be able to do banking the way they teach, the way we do it. And so to build a policy that has all those attributes and liquidity, which is the most important piece here, you have to add into these policies certain riders or benefits that give you upfront cash value. And so the base of the policy, the structure of it is whole life, but actually most of your premium will go towards what's called a paid up additions rider, a PUA rider. And any dollar that goes to that rider is all immediately available to you in cash value. And so now you're still getting money in the life insurance policy. You're gaining all those attributes, but now it's also liquid. And as you gain interest and dividends and the real base, whole life starts to kick in and builds you up cash value long term, this policy becomes a very efficient vehicle to store money, but it does have to be structured correctly. And so that's what our team does. And we would build a policy based upon what you're trying to accomplish. If it's like debt, or if it's a rental you want to buy, or this is just a place to store money and a diversification of your other assets, depending on what you're looking to do, the policy could be structured differently, where there's maybe more of your premium going to paid up additions, the cash value rider that I mentioned, or less of your premium going towards that. And so really based upon what you're doing, we build that policy. And so we teach a lot about how you can become your own bank, just like the Rockefellers. And you becoming your own bank means it's your stuff you're setting up. It's not Carson setting up and managing a policy for you. It's you. And so we want to make sure you understand it and you use it best for your scenario. But really, it just comes down to what you're looking to accomplish.
Yep.
What are your other thoughts, guys? It's a long answer, but
Curtis, Carson, that's a great answer for Curtis. Like, that was a great way to explain how to build these structures. And I would say, Curtis, another piece of this is John Rockefeller and his team had a big vision. Like Rockefeller was famous for just sitting there and just thinking and thinking and thinking and thinking. And he really found the space to think what that big future looked like. You know, there's a lot of neuroscience out there right now. You know, Ben Hardy wrote, you know, Be Your Future Self. Viktor Frankl wrote about it, going through the Holocaust. That as long as we have a bigger future than a past, we're always going to be pulled towards that future, right? And what you're asking is the Rockefeller structure uses not only trust, but it's using the whole life to keep the generational wealth going. But he's had the vision. The Rockefellers had the vision. Other families have had the same kind of vision. We have people on our team that have this kind of structure as well, where when there's a new life event, a new child, a new thing that happens, a new business partner, you're expanding your warehouses of wealth that Carson was talking about in this design phase. And then as you're expanding that, that's compounding uninterrupted over time. It's away from the government. When that person passes away, when they die, right, and that death benefit pays out, then there's already stipulation of what's going to happen next. And that's usually inside of a trust or something else. And that's how it keeps going from generation to generation. And as Brian was talking about right at the beginning, he was talking about the knowledge that has to be passed on, because if you don't know how to use the tools and you don't understand the structure and the game we're playing, well, then it's going to stop a generation or two down the line. But a lot of super wealthy families, like I have a friend or an acquaintance, like one of the positions he's thinking about taking is to go be the person that teaches to the next generations all the financial literacy, how to use the specially engineered whole life, how to have the money habits, how to save more money, how to invest the money, how to tithe, how to do the tax pieces of it, to really help them have that financial education. So it's a big picture, sitting down and thinking, knowing what you want, and then helping us tie today to that future.
Yep. And the other one that the Rockefellers, what they call it, is called family banking. Family banking is where everybody has a policy, but you have like a core thing, like as Jason said, the trust that then controls all of the banks, essentially creating that family bank. But if you ever want to learn more about the book, What Would the Rockefellers Do? Great book. We're actually reissuing that through the Money Multiplier. I believe there's our BYOB here soon. Okay, let's see. What are the questions we got here? All right, so Rose said, hello, gentlemen. I'm looking to start infinite banking and would love to get in touch with someone to see what my options are. Thank you. Yeah, we're gonna put a link here in the chat box in a little bit so that you can actually schedule a call with one of us or with one of our team members and go through infinite banking with you. All right. And anybody want to answer this question?
Where are the ladies today? I don't know. We miss them. I miss them.
Oh.
So I know there's one of the ladies is sitting in the room with Mr. Noggle, Mr. Joe K, Mr. Snaggy, Mr. Craig Yenny. I was hoping they make a guest appearance, but they're up to some important stuff. Like I was talking about, they're thinking long term. They're sitting down saying, how can we best move this mission forward, and already planning for 2025 and beyond today. So,
yep, absolutely. All right. Kevin has a good question here. Does it ever make sense to open policy on teenage kids with a 10K base, 100K PUA, and borrow 100K from the first one to open the next one, etc. 4 times? Is that a good strategy, or just create 400K of debt?
Hey, Kevin, it's a really, I love that we're only limited by our creativity, but unfortunately with our kids policies, there are going to be limits of how much the kids policy can be structured for, which for most cases is going to be up to half whatever the death benefit is on the mother or the father, whoever has more, up to $1 million. So just imagine they can be insured for up to $1 million. Usually that's less than $10,000 or less per year for most carriers, for most mutually owned companies we work with. And with this kind of structure, with your idea, you might be able to do it on adults, but you won't be able to put in those kind of dump ins on kids, right? And then maybe we can take the rest of that question for the last piece of it.
Yeah, that's exactly. You can't really put those kind of large. Well, is that Gabe?
In one of the Money Multiplier masterminds, that was a couple of years ago, Brent did a really good training on stacking policies. I'm pretty sure I could find the recording. I don't know if he would somehow get access to that, but Brent goes over how to do that. But like you guys said, you probably can't do it with the kids, right? You probably can do it with adults. But those are also more advanced strategies. Unless you already have been kind of practicing, it might be better just to kind of start with like a normal policy before you try to stack them and borrow. But what were you going to say, Brian?
No, the same thing right there is that, yeah, I mean, you can do what you call policy stacking, where you're borrowing from one to do another one, but you've got to understand the flow of money through those things and understand how you're going to be putting money back into all the policies over time. Because you can get out of shape doing that, and it's not a good thing unless you really can follow the money. And so it's the same thing when someone borrows from like a HELOC to fund a policy. You've got to understand the flow of money through both of the vehicles, and it has to make sense to you. And I've had a lot of people that are trying to do that, and I tell them, don't move forward until it makes sense. If you don't understand the flow of the cash, don't do it until it clicks. I've unfortunately had clients that had policies set up with another provider, and they were doing that, but they were never taught how the machine works. And all of a sudden they find themselves in a situation 4 years down the road where their policy is now going the wrong direction and it's starting to lapse because they didn't know how to pay it back. So just be careful with that.
And for this, I mean, Kevin, it seems like you're looking for creative ways to make the money go further. The most creative thing you could do is take over the function of banking in your life, because then you already turn $1 into $2 immediately. You have one that's growing forever, uninterrupted compounding, and now you're going to go make a spread. So if you're creating that $10,000 policy with a $100,000 dump in or whatever it looks like, and you're borrowing it out to put it into something where you can make a spread, where you know, like, and understand it, then that's a good strategy. Then learn how to do that and do that really well before you start wondering how you're going to have a lot more warehouses to put your money in. Like, the only reason I think that you might even think about something like that is maybe, well, it's never a good place to go from feeling like you're playing catch up. But like, imagine like Carson's 22, like I'm 50, right? So like, you get to a certain age, you don't know, we never know when we're going to have a life event when we can't get approved anymore. So having warehouses where you can store more wealth makes sense from that perspective. But you also, like Brian said, you have to be able to manage the money, move the money, create enough money to go into the policies, to take good care of them. You want to be an honest banker. You don't want to set up 4 failing businesses versus just setting up one business that runs super efficiently and then expand once that one's so efficient that it doesn't make sense not to expand.
Yep. All right. Curtis has another follow-up question here. How much money can I put in per year to prevent it from becoming a MEC? So MEC, modified endowment contract, which you don't ever want to have a MEC policy, taxable. It's under the purview of the IRS, that kind of stuff. But anybody want to answer that question?
I mean, it's specific per policy. And so it's not like, you can only do 50 grand a year. Like, no, it's different for every single person, every single income level, your age, how much premium you want to put in, how much you're going to dump in up front. There's a lot of factors involved into that. So really what I would just tell you to do is find out when you set up the policy, how much your base premium is, how much paid-up addition flexibility you can do, and that's really it. Once you know the max PUAs you can do up to your MEC limit and you know the base, then you have complete control now. You can pick how much of your premium you're paying into it. Whether you adjusted the base, you did some PUAs, you did all the PUAs up to the MEC limit. Just for you to understand what the MEC limit is based upon that specific policy, that's what you should figure out. Now, your question being, how much money can I put in per year to prevent it? I mean, it depends on the policy you have. So more so, I would just figure out what the MEC limit is on the specific policy you own. Or if you want to set up a new policy, say, hey, I think on the minimum, I could probably contribute this amount. And at the max, I could probably do this amount per year. Maybe we set up a policy where your MEC limit is that amount, so you don't contribute more than that, but we're also allowing you to put that much in if you need to. So it really depends on the scenario. Maybe you can give us more answers in the chat.
Yeah. And additionally, when we build these, we call it max funding. So we build it so that you can max fund the policy without MECing it. You can't go beyond the max limit. If you do, then it can become a MEC. So we build it so that it doesn't happen. But if you try to put more into it, like you try to shove 11 pounds into a 10-pound bag, that's when it would MEC. So just know as what he said, just understand that limit.
And we can make a fun play on words instead of calling it a MEC, right, a modified endowment contract, which just means it becomes more of a taxable event, still whole life, so it still could be valuable. But what we do create is a maximum efficient contract. Like Brian was just saying, I haven't heard that one. You can't put 11 pounds into a 10-pound bag. Usually do the water analogy, like you can't put, 14 ounces into an 8-ounce glass, right? Like you get to a point where you can't stuff anything more into it. And that's when you expand your system. Because Nelson does talk about at some point, all of your income should match all the money going to your bank. Because when you earn money, where's the money go now? And this is just logic, people. Just think about your thinking. When you make money, all the money you make goes into what? A bank. So at some point, your banking system should be big enough to hold all your money. But you don't get there overnight. It takes time.
Yep, absolutely. All right, let's see here.
Can I ask you guys a question? Have you ever, I know you're going to read this one, but have you guys ever thought, like if you think through the 5 principles that Nelson teaches us, right? Think long range or think long term. Don't be afraid to capitalize, which is pay yourself, right? God, self, neighbor, right? 3 is don't steal the peas, right? 4 is don't use outside lenders. That's what, the average American is giving away 35 cents of every dollar. And 5 is rethink your thinking. If you think through every question that's asked here and every question we're asked on a daily basis, and you apply those principles in order, it makes talking about this, I find it makes talking about this stuff a lot simpler.
Yep.
It's like a super easy frame. I'm just curious, do you guys think of those kind of same way as I'm thinking or differently or?
Yeah. You gotta understand that we're programmed to think a certain way, and you got to sort of catch yourself sometimes when you're thinking that way. And the older we are, the more ingrained that thinking gets. So like Carson, as an example, probably doesn't have some of the programming that I have because he's learning stuff so much younger, which is awesome. So I've had to rethink my thinking, as Jason said, and I still to this day have to do that all the time. I catch myself. So yeah, for sure.
Same. I mean, your first couple policies, your first couple premium deposits, I mean, they feel like bills at first. You're like, what? Oh my God. Like I forgot that one's coming up at the end of this month. And then you're making your premium deposit and you have to train your brain. I'm excited to put my money into my premium deposit, but guess what? You still have to create the money, right? So
there you go. All right. Christian has a question here. How do I fund my policy if I don't have the entire monthly deposit? Or would you hold off till you have every dollar for that first month deposit? So, well, if you don't have the deposit, you wouldn't really want to start the policy until you have the cash flow to put into the policy. I mean, that's pretty much how we would walk you through that. But yeah, I mean, if you only have $500 left at the end of every month, I wouldn't recommend putting $500 into a policy. You've got to have some, breathing room inside there. But you have to really understand your cash flow. And this was a good conversation that we had actually on the team call here a little bit ago, talking about, do you understand where your money's coming and going? Do you understand where, the expenses you have? A lot of people don't know. They don't know where the money's coming and going. And that's just called a budget, by the way. So a lot of our conversations around that kind of question are, well, what's your budget? Where's your money coming and going? Are you in control of it? That's kind of my response to that one.
And the answer to Christian is you can't start the policy if you don't have the premium. So, and just so you guys know, I know Christian, he's starting his policy right now, actually. So congrats to you, man, for starting your first banking policy. We're gonna go pay off some debt and stuff. So I'm excited for you. But we don't fund your policy until you have your premium in hand. And if the premium is too high where you don't think you'll have it comfortably per month, then we should drop it. So just shoot me a text and we can talk about it.
Cool. Love that answer. All right. So Matt had a question here. How do you recommend setting beneficiaries up if the death benefit is meant to go towards your kids in the unfortunate situation where both you and your spouse pass when you have very young kids? That's a great question right there.
It's what a trust is for in a will.
Yep. So bottom line is if you have kids, young kids like I do, you have a trust. And the trust is going to be the one that, so of course I have a spouse, so that they're the first beneficiary from mine, the way mine's structured currently. But the trust can be the next beneficiary with your will inside of it that then spells out your wishes if that situation does happen. Because if you don't want kids getting that kind of money, because that can be a bad situation, they can be taken advantage of, all that kind of stuff. So for sure.
I mean, it would go to probate and everything else too, right? So you have to have the trust. Trust the beneficiary. Like, think of it that way. Like, if your kids are minors, it's going to be trust the beneficiary. Like Brian just said, then you have your will stipulating like who you're trusting to, administer that money for the needs of your kids, right? So that's how we have it set up. Like, pick 2 people in our lives who we would trust with taking care of our wishes, being aligned with our wishes, and you set up those things. It really forces you to stop and think about all the next steps if you're not here. So it's a good question. Great question.
And then another question that came in is, can a minor be the beneficiary of a life insurance policy?
I wouldn't think so. I don't know the answer. We could find out, but I wouldn't think so.
Yeah. So that's another part of it, is that can't even be an option. So you have to have some sort of vehicle like a trust in place to be the beneficiary in that situation. So yeah.
Yeah, most of the time, life insurance, like when you want to become and do what we do, or just you're curious about it, it's really stupid simple too. Like it's whole life, like it's your whole life, like your entirety of your life, right? So most of the time, the words that are used are the actual words that it's pretty straightforward with the meaning of it. So, so like something like that wouldn't make sense because it's always around the family unit. Like, even though we teach banking, it's about the estate and the family and protection. Like, that's what whole life is for.
Yep.
God bless.
Thank you.
So Jay said, so we have moved away from the 60-40 for all policies being issued, ? Does 80-20 or 90-10 make sense in some instances? So no, I do 60-40. I've even done 50-50 and 40-60 policies. So the structure of the policy is going to be dictated based upon how you're going to use it and how you're going to fund it. So we, as IBC practitioners, will structure that in the most efficient way possible for what you're trying to accomplish. So sometimes that's a 90-10, not very often, by the way. Sometimes it's 80-20, sometimes 60-40, sometimes 40-60. It just depends. And by the way, when you're referring to the splits or these ratios, you're referring mainly to the premium, okay? The premium deposit, okay? If you're doing like large dump-ins, those are 90-10 by themselves. So it's, once again, we actually find out what that is based upon your use for the policy.
Yeah, when people like look at 90-10s and things, like, it makes a difference with how many zeros are on the end of it. Like, I think some of the original, my understanding, and now I could be wrong, like Brian, please correct me, or anyone who knows more than I do. I like learning, love learning. But if someone, like a business, is like, hey, I want to put $1 million or $2 million into a policy annually, and they have the ability to get approved for that, well, that 10% is 100 or 200,000, right? That's a lot more base than someone who's like, oh, I want to put $8,000 in, and I want 10% to go to the base, because that requires a lot of additional term. It requires a lot of additional things, and it doesn't make sense for the long run a lot of times. Like, we haven't created the habit. In my mind, this is how I look at it. We haven't created long-term thinking yet. We want to do this, but because our habits aren't there yet, we're not able to give up a little bit of money for the first couple of years to have some patience to grow over the long period. We're like, I need all that money right now. I need all that money right now. It doesn't really matter. I'm not thinking about tomorrow or the next day or the next year. And you really shoot yourself in the foot. Like, you don't understand banking if you're always coming and asking for that question, in my mind.
Yeah. And I've done the 90-10s for people before, but the challenge is that you have a lot of early cash value, but down the road, there's not very much growth in the policy. It's not very attractive down the road, versus someone does a 60-40, they have less cash value day one, but all of a sudden down the road, they have a lot more growth in the policy, and it'll actually surpass, as far as cash value growth goes, and death benefit, the 90-10. It'll beat that policy sometimes.
I designed something today, Brian, just for someone that's looking for an 80-20. And I just keep saying, we can do that, but it doesn't make sense. And so I took the numbers he gave me with his 80-20 and just redesigned it like you would do, or Carson would do, or Gabe would do. And I shot him back an illustration as like a 50-50 with 92.56% cash available in year one.
Yeah. Yep.
Like, okay, find me a 90-10 that can do that. You can't, because you can't put a dump in it.
Correct.
So
There you
like
go.
a 90-10 could never look as what I designed for you at a 50-50. Like, go figure that out, right? Like, you have to understand this stuff. It is specially engineered for each person.
Yep.
And it comes back to what we teach. We teach banking, right? And if you read Nelson Nash's book, Becoming Your Own Banker, he talks all about banking. But in every single policy example he gives, all the charts he shares in that book, every single example, he does not show you taking out a loan for the first 4 years. He shows you capitalizing the policy. Because we're starting a banking business, we're starting to build a system, and it's going to take time. Now, does that mean you should not start a policy if you can't touch the money for 4 years? I mean, no. I mean, sure, you should take money out, pay off debt, do your thing. But that mindset of let's
Sorry, guys, I got to go. See you next time.
Have a good class, man.
That's important.
Yeah, 100%. Yeah. And it's kind of cool. I mean, if you read Nelson's book, obviously it was written a while ago, but now we have different products that can allow us to do both things, have early cash value and also, down the road growth as well. So a lot of cool things we can do with these policies. Let's see here. All right. So Jay Dunn said, I was just told I needed to start paying my loan back or could be in trouble of losing policy. That sound right? Thought I just had to pay the interest back each year. This is One America. So yeah, at a minimum, I recommend paying the interest. So that way that it doesn't compound negatively on the policy loan. But if you're paying back the interest, then you shouldn't be at risk of losing the policy. So that doesn't.
I would do, James, would reach out to your implementation specialist. If you haven't already, it sounds like you're probably already in communication. And then also your money mentor. Get to start the dialogue, start asking the questions, because then you'll find out what's really happening. Like I have had someone this year where they had changed where the policy was being funded, and then they stopped funding at one point. And so like they were given credit for a premium deposit that didn't go in, and then they took a loan. And so if they didn't repay that, then it did start to put the policy in danger, right? So you want to find out what's going on, because at the end of the day, we're all people. We're all, doing the best we can do. And depending on what you've done, how you've treated it, what's happening, just get clarity on what's happening. Ask questions.
And we can also run an illustration to include the loan and see how it will project over time. So yeah, definitely reach out to your person. All right. So living the life. So paying back your loan will have no effect on creating a MEC. No, paying back your loan does not affect the MEC status of the policy. Now what could impact the policy is if you were paying back the loan plus 5% interest, but you're paying back 10% interest. You could overfund the policy by paying it back, but they usually won't let you do that. So if you try to do that, the insurance company is going to call you. They're going to call us and saying, "Hey, what's going on?" And I say that because I just had a client do this. They sent in an additional $5,000. The policy was only allowed to have $4,000 go in. They put in $4,000. They sent in an additional check of $5,000, and the insurance company was like, "Hey, what are you doing?" They were calling us. They were calling the agent, calling the client, and they sent the money back. So they won't let you MEC a policy very easily. It's very hard to do that, by the way. Have you guys ever had anybody MEC a policy? I've never had anybody do that.
Yes, I have. I've had someone MEC a policy, and they actually, and it's funny. I think it was kind of like they sound like cowboys and a little bit like rogue agents when I heard that Devin Burr and Brent Kessler did this as well. When they sent in more money than their policy could hold, and they knew it, just to see what happened. I was like, well, why didn't you just call them and ask them what would happen? Like I thought that was kind of crazy. But I have had someone where they thought they could pay their premium deposit for the year like 3 or 4 months in advance. And so they sent it in. And what the insurance carrier did, the mutually owned company did, is they sent them back a letter and said, "Hey, you MEC." It was pretty interesting. It was a giant, page of information. "You have caused a modified endowment contract, and this is what that means." And it went and outlined everything it meant and said, "Wow. If you did not wish this to happen, we will return the amount of money to bring it back to a non-MEC status, and then they gave a phone number and like a person they could contact. And so it was pretty cool. Like it made me feel a lot better because I know, again, we're all moving fast. We're all using banking as a part of our life to help with everything else we do, all the other businesses we have. But, you know, you can make mistakes. I sent my premium deposit for my son's policy in today, and I put in the subject line, you know, policy premium deposit due on 11/22, put the policy number. And when I did that, I got a message back. I'm guessing it's an automated message saying, you know, we can't take this because you can't pay your premium. Here it says, the policy is paid too far in advance. Please contact our customer service department at the number listed below to request the policy to put on APP. Your policy is also currently on annual bill. Like it gave me like a whole bunch of things. And I was like, oh, I guess I should have just called. I was intending to call and I just sent an email. So.
Gotcha. Huh. That's good to know. Curtis, so he said, yes, a minor can be designed as a beneficiary of a whole life insurance policy. However, there are important considerations to keep in mind when naming them. So yeah, as an example, so like me, I probably would never name a minor as the beneficiary. I would do it as a trust so that it's addressed there, but that's good to know. All right, let's see here. Okay, so finally, Suyin said, I've heard of people with two policies that are set up such that one policy pays for the other. How does this work?
This goes back to the waterfalling strategy that another person brought up earlier, right? With like if you had, like, imagine this, though we don't necessarily teach this, but you know, it's always your creativity and how you do things. So let's say you had one policy that you funded at the beginning of the year for, I don't know, say it's $20,000. And then later, 4 or 5 months down the road, you have another policy that's maybe $15,000. So then you're putting in the 20, whatever is available, you're taking out for a loan, and then you're starting the next policy, and so on and so forth. That's kind of the idea that's being taught, right, or mentioned. So,
yep.
Not something we're not recommending. We're just talking about your question that you're asking. So.
Yeah, borrowing from one to pay the other, you can do it, but at some point you've got to make sure that you're flowing back into the policy loans. Like that's how we teach it. You want to make sure you treat your bank the same as you treat any other bank, like a traditional bank, right? Don't steal the peas, as an example.
Yes, don't steal the peas. Go back to our long-term thinking. Don't steal the peas. Don't be afraid to capitalize. So you're probably not ready to start that second policy if that's what you're trying to do, unless there's a good reason, like you're protecting, maybe it's a husband and wife when you're wanting to protect the family. There might be reasons that you would think that way, but I don't know if it makes sense for banking. So
yeah. All right, Christian had another question. So my premium is okay. So this is Christian said my premium is fine. I'm just trying to settle down because I'm too excited to get my bank started, and I have a minimum deposit to implement the policy till I can get the rest of premium to start paying off debt. So I don't know. Does that make sense to you, Carson?
Yeah, it does. I texted him as well, actually. So
all right, there we go.
Carson's got you, Christian. We're glad you're excited. And congratulations. So
that's awesome. Yeah. All right. Jay said, my thought is if I'm leaving or leveraging my HELOC to fund a policy, a 60/40 is giving up the opportunity cost as I would need as much back in years 1 and 2 to put to use. I'd open a second policy later, 60/40.
Again, funding the policy with the HELOC. We talk about this a lot, Jay, and we're so grateful you're always here. But we also want to look, you know, like HELOCs are variable. I know it's the velocity of money. But you're coming in at 7.5%, 8.5% is kind of the current market that I understand or I've seen. And so then if you're making a spread on that, you're borrowing another 5 or 6% or even 7% from some of the carriers right now. So you're already looking at needing to make more than 15 or 16 or 17% to make that move make sense.
Yeah.
Right.
Now, Jay, if you're doing velocity banking with the HELOC, you can cut the interest rate down significantly. I think Joe said you can get them down to potentially 3%. But once again, you have to understand the flow of money, and additionally, what are you doing with the policy? So a lot of people will say, "Hey, I want to borrow from the HELOC, fund the policy, then borrow from the policy to pay back the HELOC." And you can do that, but once again, the cash flow has to make sense. Now, if you're doing velocity banking, then what you can do is not pay back the HELOC, do velocity banking there, borrow from the policy, and put that money to work for you, because that's where the money can work for you, creating that return. But you have to really understand that process and understand the cash flow. And so I've done this with quite a few clients, by the way, that are doing HELOCs, doing infinite banking, but there's multiple steps in the process. So you got to understand each step by itself, and then understand how they then work together to accomplish your goal. So bottom line is what's the goal here? What are we trying to accomplish? Obviously funding the policy, but outside of that, why are we doing this?
Yeah. And I have some thoughts on this too. I mean, there's all kinds of different opinions on, especially on our team and just in general with sound financial advice of how to leverage a HELOC and policies and how to combine the two. And to be honest with you, Jay, I personally wouldn't do it. Might be unpopular in our team. I don't know if I would ever do it myself. I think there's just way too much risk involved. I think if you're taking a HELOC, you'd have to be very careful and certain that, one, that bank's not going to go bankrupt, one, or two, that rate's going to stay fixed because it could be volatile. Then when you fund a policy, take a loan, you have to make sure that you account for that loan interest and your HELOC interest. And you have to make sure that investment's going to produce a high enough return to pay both of those. And you have to be so confident that that investment's going to crush it for a long period of time that it eventually would pay those things back and it would work out. But for everything to go perfect just to maybe make a tiny spread, I don't think it's worth it for me. And if you, like Brian said, if you don't know exactly what's happening with your money every single step of the way, you could screw yourself. And so if this is your first time doing it, I would never do this strategy. Personally, if this was your first time talking to us about policies, I would not incorporate the two. If you are very advanced into this, I'd say go for it if you understand the math. But that's just my personal opinion. I don't know if it makes sense.
Carson's saying lots of variables. That's what I'm hearing Carson say.
Yep.
Lots of ways to make mistakes. Sounds like an IUL. Who said that?
Brent said, yeah, a fixed rate HELOC, actually, if you can get a fixed rate one at a lower rate is a good idea. But yeah, but you also got to look at the bank, because the bank can shut your HELOC off. It happened to a client of mine a few weeks ago. They shut the HELOC off. Now, why do they do that? It's because their credit score dropped significantly for a certain reason. So, but there are certain banks that have never locked a HELOC. They've never stopped them. Back in last recession, that happened to a lot of people. The banks were shutting off all the lines of credit. Some banks don't do that. So you want to find a bank that you can trust, by the way. So, and not all banks are equal. All right. Jacob said, is there a resource that you have where you can track the cost of borrowing as opposed to paying off debt, as opposed to investing into real estate? I mean, that's the
main projector, maybe.
Maybe, but there's a few things going on.
I mean, is the question, does the math make more sense to pay off a debt or invest? Whether it's coming from a policy or not, the question comes down to what's the difference of making an investment or paying off the debt. That's really the gain you're going to get out of the whole scenario. So that's simple math. I don't think you need to build a whole resource or spreadsheet for that, unless there's more to the question.
I'd just run the numbers. So there's a website called dinkytown.net, I think it is. But it's Dinkytown. It's the funniest name ever, but it's Dinky and then town, and I think it's net. They have a ton of financial calculators. It's all free, but there's hundreds of calculators there. I use it all the time. Just go there and run each scenario, and then see what it comes up with. But I don't know of a resource that does all of that in the exact same calculator. It's just you have to look at each individual scenario and see what makes the most sense.
And Jacob, here's a like an actual example, a case study example of someone I was talking to yesterday, right? Has an airplane. It owes $109,000 on it. It's a little Cirrus, right? It is $2,500 a month, and it's 4%. Okay, so there are the numbers. It's $109,000. It's 4% interest, and it's $2,500 and change a month. If he was making an investment, say he's making a hard money loan of that same, let's call it $100,000 or $110,000, and he lends it to somebody, for a developer, for a year, and they're going to pay him 12%, that person would make $1,100 a month at 12%. But if he paid off the plane, the debt that he already owns that has absolutely no risk, right? Are everybody following? You would more than double what you would get in a 12% investment, even though he says 4%. Like, don't look at the percentages, look at your cash flow. That's my overarching point. Look at the cash flow so you can make that decision. Like Brian said, do the math, but sometimes the math's not that hard. I don't need a calculator or Dinky Town or something else to help me figure that out. So,
yep.
It's probably just because I don't like spreadsheets and calculators. I'm not good in the sheets like these guys.
Yeah. Finally, student said, policy paying for the other similar to credit kiting. Kiting? Kind of, yes. Kind of. But just once again, you just got to be careful, because if you don't know the cash flow and don't know where the money's flowing, you can get into trouble. Same with the credit strategy too, which is going from 1 to 1 to 1. It can be dangerous. I've done the credit one, I believe, before, but I got out of it pretty quick because I wasn't comfortable with it. So yeah.
Yes, true. Spreadsheets are your friends, but that's why I have smart people that can use spreadsheets that are my friends. But back to that question, I was just curious about that because I've never heard credit kiting before. But like, if we're looking at what happened in 1913, just for fun, if we're looking at the Federal Reserve, right, that's not even a government agency, or if we're looking at the IRS and the 7,700-page book, which is the longest in history and still expanding to this day, and like Brian already said, you got to find banks you can trust. And if you know the whole system is already not very trustworthy, because it's allowing, basically counterfeiting money, if you will, printing money, creating money out of thin air, then other philosophies or other strategies that come from that world, why would you want to bring them into the banking world of taking back control and bringing it back to a you and me level? Like just thinking again, just back to the thinking, the 5 principles.
Yep. So Linus actually said underwriting. Now, Linus is one of our application specialists on our team. So
application specialist. No, just kidding.
Yeah. So he says underwriting does not allow minor to be the beneficiary initially, but you can change it down the road. So there you go. So some more clarifications on that. So that's interesting for sure. All right. So Michelle, let's look at a 2-part question here. So I read somewhere that Nelson Nash did not deal with banks at all except for petty cash debit card purposes. Part 1, correct. In this scenario, does this then imply that any new cash intake, windfall, salary, etc., should be used to fund an existing or new policy? Yes, and yes, and yes. Pretty simple answer there, but yeah, exactly. But yeah, I mean, so we have to. There's banking transactions and banking functions. A transaction is cashing a check, debit card, paying your bills, that kind of stuff. A banking function is the borrowing and lending of money. So that's really kind of, and a storehouse of money as well. So that's really what infinite banking does replace. I get that question quite a bit. I don't know if you guys do, but I get that question a lot, saying, okay, how do I run all of my expenses, food, clothing, gas, through the policy? Well, if you don't pay interest on gas or milk, why would you want to start doing that? So,
because you earn money on that money forever, uninterrupted compounding away from the government. So like it's like your thing that you love more than anything in the world, or the idea more than anything in the world, you discover it one day and you're like, where the F was this for the rest of my life? And so then you just want to do it as fast as possible. Or like you see someone that's like getting onto their jet and they got out of their super nice car and got onto their own personal jet, and all you see is their success. You don't see the 20 years before that of them capitalizing, of them putting in the work, of them growing to a level of mastery in whatever they've done to serve, to solve other people's problems. Like you see Chris buying Porsches all the time. I'm like, I'd like a Porsche, right? But like comparison's a thief of all joy. And you have to understand that when someone has that much success, it's not usually an accident. Like they did a lot of work to get there. So the same thing with the banking. It takes work to get there to be able to run all of your income through, because you can only put 20 to 25% of what you earn into a policy, right? So
yeah. Andy says, you wouldn't even be allowed to put 100% of your income into a policy
because that's risk. It's risk.
Yeah.
So an insurance company won't even let you do that because it's just too risky, because your income changes, all of a sudden you can't pay your premiums, all of a sudden policy lapses. That's bad business and bad banking.
Yeah. You know what's funny, Brian? You mentioned it a second ago. You said the banking function of your life is depositing and lending money. I looked up banking just online, and it said banking is the business of protecting money. And I thought that's really interesting, but that's the noun version of banking. And then the verb version of banking was lending, protecting, and depositing money. And so, like you just said, that's what banking is. It's the verb of moving your money around. But the idea that banking is just the protection of money, the business of protecting money, that's not what we do when we deposit money with Wells Fargo or Chase. They're kind of protecting it, but we're not. So that it reinforces the idea of why we want to be our own bank, so we can be in control. We can actually store our money somewhere that we can then, business of protecting your money. We can protect our money in our own banking system. And so that it reinforces why we want to be their own bank.
Exactly.
Again, it goes back to the best thing that you've could ever find. And you're like, well, again, if this is true, why did I know about this before? Right, Carson? Why do I know a way I could actually protect my money and stop giving it away to someone else that's making all this money on my money? Well, hey, don't be mad at the bank. They're just really good at the game. Go be the bank. Go set up the structure so you guys can learn how to make money in 3 places with the same dollar.
What do banks do? They control your money. Like, we literally give them our money and now they control it. Like, it is crazy when you understand the banking system. It's really kind of scary.
We could probably have a whole AMA on that sentence. You work really hard. You trade your time for money. We could have people come in here, tell us how they make their money, right? And then ask them where they put it and say, hey, did you know that you actually don't own that money anymore legally? Like, that still blows my mind. Like, I still don't even like putting my money in Bank of America when I have it, or in my first saving. I'm like, wait, I don't own that money anymore. That's what I think now.
Yeah.
Can kind of mess you up if you go down that rabbit hole.
Yeah. Christian had a question here. So would you lend on a deal in Private Money Club, PMC, or do bank note investing? Of course, when out of debt. Now, this is not financial advice. We're not licensed financial advisors. This is not tax advice or anything like that. I would actually say, what do you know better? Like, which one do you have knowledge on? So if you have more knowledge on bank note investing, by all means do that. If you have more knowledge there, if you have more knowledge on private lending on PMC, do that. So depends on where your expertise lies. So that would be my kind of response to that one.
Good answer.
Yeah. All right. Well, we're almost at the hour mark. I don't see any other questions in here.
I have one for you guys. Let's do one more. Somebody text me this question. I gave my best answer, but let's see what the brain trusts, right? We're in the brain foots. See what he says. And Carson. So I have someone who their husband has an IUL. He has a loan out on his IUL. I'm actually trying to pull up the numbers right here. Has a loan out on the IUL, and he wants to 1035 it.
Mm-hmm.
Is he able to do that?
Yes. You 1035 what? So you'll 1035 the outstanding or the unused cash value to the new policy, and then the loan will be wiped out. Now, Linus did tell me that he has seen I think it's at Security Mutual, the option where you can move over the entire cash value and the loan, but he's only seen it with Security Mutual, and he's never done it before. But I do know that you can 1035 the cash value that is not the loan that's not in the loan. So if you have $10,000 of cash value, $8,000 loan, 1035 $2,000.
Exactly, that's what I thought. And then the surrender charge too, because you're gonna there's a surrender charge still. So like this one has $10,316 of cash value, outstanding loan of $5,268, surrender of $2,400, total surrender available $2,640. So
Okay.
Yeah, David and Dorothy, did that, lost a lot of money on the surrender. Yeah, that's one thing about the IULs and those kinds of VULs and ULs, surrender fees, surrender charges, all of that garbage. It's really unfortunate that people get kind of locked into those, not understanding the surrender fees and what they can actually do if you need to get out of the policy, you can lose a lot of money. Yeah, so as they said, so just if you're ever doing an IUL for whatever reason, better understand those kind of things. Or just not do an IUL.
Yeah, I mean, again, if we talk about control, we like control. Who do we want in control of our money? We all want to be in control of our money. You, Brian, Carson, everyone that's here, Andy, Michelle, Drew, right? We all want to be in control of our money. So don't do an IUL because you're not in control of your money.
Yeah.
Yep.
The insurance company is, and that's just a fact, right? Look it up. I mean, we're not. I don't know. I mean, that's enough for me. I think you can keep it really simple. Why not to do it? Well, because you're not in charge of what happens.
Yep, exactly. Exactly. And I just found the intro video. I guess I can do that. There we go.
Okay.
All right. Well, that is Ask Me Anything, everybody. I did put in the chat. I did put in the link to grab a time with one of our team members. I'll go ahead and put it back in there one more time.
Good job, Fouts. You're reading questions. You're running the control panel. That's a lot of stuff going on. It's like doing Take Back Control Tuesday. Do you guys know on Take Back Control Tuesday, I logged into the wrong account and I did not turn on the presentation for like the first 11 minutes this week. It was the best one I've done, right? I had to even say that, when you ask how do you eat an elephant? Oh, it's one bite at a time. No elephants were hurt. All elephants are safe. They will not be hurt. But anyhow, it was a hot mess, but it was a lot of fun. So it's a lot of pieces that Brian's running. So thank you, Brian, for doing all the things you're doing today. So
Absolutely. And finally, Suyin asked one last question. May sound, Perel. That's all. I like that one. But is it possible to parlay equity in a property to pay for a policy? Not very easily, not without getting a bank involved in most cases or a private lender. But yeah, that would be leverage, by the way. So that's why HELOCs are pretty powerful. So yeah, but obviously when we talk again, we can go through that question as well.
Yep.
All right, everybody. Have a great rest of your week. Thank you so much. And there's the link if you want to grab a time with one of our members or team members. So
remember, it's thankful week or thankful month being Thanksgiving. So come back next Wednesday to see us. Come back next Wednesday to see us. If you're in town, if you're with family, bring your family on. We're a lot of fun to hang out with. Maybe next week we'll even have some beverages since this is happy hour. Ask Me Anything. So be blessed. Thanks for being here. Brian, can you play a video for us? Carson, anything to add?
I love it. Thanks, Jason.
All right.
let me see if I can do it.